This is the public portion of the November 2nd, 2023 Investor Advisory Committee meeting. I'm Jeff Brickman, and along with the other co-chair Shandy Smith, we'd like to welcome everyone. As a reminder, the views expressed by the IAC members are their own and not necessarily representative of their firm. Likewise, board member views are their own and not necessarily representative of the entire board. We'll be recapping the conversations that we held throughout the morning with the help of IAC members who will provide summarized comments of the views that were expressed. After those summaries, similar to how we've conducted our prior meetings, if you want to add to this discussion or have a question, please press the raise your hand button in order to speak. If you would like to jump the line and speak because you have an immediate point to make, raise two physical hands and we'll see you and go straight to you. Also, please try to stay on mute until it is your turn to talk. As a quick note, we have Jonathan Wiggins from the SEC observing us today and on the call as well. We had great discussion today covering a number of investor-focused topics and held a discussion on IAC member observations of emerging issues and trends in today's markets that they or their colleagues indicated could have financial reporting implications. We also had Hillary Salo, our technical director, provide an overview of standards that are expected to be finalized by the end of the year, including income tax disclosures, crypto assets, and segment reporting, along with some observations around supplier financing program guidance that was issued last year and went effective already, other than a roll forward that will hit next year. Hillary also provided an overview of the broad landscape of our current technical agenda with updates on both next milestones and expectations. We met with project teams and had lengthy discussions around two areas. The first we will discuss is income statement expense disclosures, or otherwise known as DICE, or disaggregation of income statement expenses. And then we'll move on to financial key performance indicators. On income statement expenses, we had a number of views expressed, and I'll first hand it over to David Pizzamente to provide an initial summary of some of the takeaways of that discussion. David?
Thanks, Jeff. A few observations that I had looking across different types of companies and industries that I follow is that we get a very good disclosure from service companies, and they're quite granular in the information they provide on the different key expense items. And for example, in transportation companies, this is really useful for me in my analysis of what happened during a quarter and what I could expect going forward as I try to update my quarterly earnings projections. For example, it might be some of the swing factors in a period, labor cost, if there's been a new labor agreement, or changes in fuel prices, changes in rental expense, things of that nature. So this is something that is extremely important and critical in my analysis. I contrast that with some manufacturing companies that I follow, where there isn't that same level of disclosure. And I fully understand that there's the issue of inventory cost that might differ between that and some of the service companies. However, having some more granular information, even if it is only for period expense, would be quite useful. If there's changes in, for example, raw materials prices, labor cost, as I mentioned, having an information to their exposure, more information about their cost exposure to each of those items would be useful in trying to project their earnings and cash flow moving forward. And I think as an analyst, I could really understand how quickly it might flow through inventory, looking at their businesses and how quickly their inventories may turn. So even having the period expense, more granular detail would be very useful.
Thanks for that, David. Maybe we'll get back in a second if there are any questions, but maybe we can move next to Catherine, who had a few comments to make.
I just wanted to highlight, I cover the banks, and we're lucky to have a lot of this information. And so I was just bringing my perspective to the group that we get compensation, occupancy expense, regulatory expenses, data processing, IT, and we use that on an interim basis, and we really very critical in our modeling in our earnings forecast. So Luckily, this won't be a big change for the banks, but I would argue that it's very valuable information that I would imagine other industries would benefit from. So that was my perspective.
Great, thank you, Catherine. Anyone else from the group? There was certainly a number of comments made throughout the morning. Any others? Yeah, Manesh.
Great. Well, I just want to highlight that generally have a positive view of the requirement, and specifically from my use, it's the peer analysis. Just having, this is information that's not really publicly available, and to be able to compare peers and see which companies are more productive and efficient is valuable. Understanding the difference between fixed versus variable costs is a great part of the additional analysis that we could do. Also, trying to get a better sense of what is the actual cash impact is important as well. So that's just generally my comments on the requirement.
Great. Moving over to Mark.
Yeah, I think these changes will be tremendous value add for my firm. As I mentioned earlier meeting, we spent a lot of time trying to figure out the causes for movements in inventory, and there's certain metrics we try to essentially back into based on the limited publicly available data that's out there right now, and this will directly provide it. One example would be purchases, which we think is a critical metric in certain of the sectors we cover. The breaking down the movement to including that other category will also isolate some of the factors that we try to kind of speculate on that currently aren't well disclosed. And I frankly wish this kind of approach applied to selling expenses as well. And by the approach, I mean incorporating a cost incurred approach, because in the world, I do most of my work in tech, and there's a lot of focus on customer acquisition cost. And these companies defer these costs and generally amortize them over the projected life of their customer relationship. So the real value is in what they're deferring to the balance sheet as opposed to what's flowing through the GAAP P&L. And disclosure on that front right now is, I would say, limited. It's mixed. It's not consistent across companies. And if we had more information on costs incurred for selling, it would be of great value. It tells you a lot about what happened for that business in the quarter in terms of new business in the door.
Excellent. Thanks, Mark. Next, moving to Heather McPherson.
Hi, thanks. I'm going to echo what Mark and Manesh said. We're in agreement here on their points that they made. We spend a lot of time looking at peer analysis, and we do that in the context of understanding where a company might be over-earning or under-earning relative to their best potential. So it's really important for us to understand breaking down the margins of the company, and that includes understanding cost of products sold. It also, the other category, which is something that is in the details here, but a lot of times the other category is very large, and being able to dive into that and understand the components of that is helpful as well. As value investors, in some of the value investor analysis that we do, we really are trying to understand how things could improve. And so being able to break down the cost components squarely across peers is very helpful. So echoing what Mark and Manesh said.
Thank you, Heather. Any other comments for the group or questions from board members? Yeah, back to Mark.
Yeah, sorry, just one more thing I mentioned. And I do want to emphasize that I think interim reporting is critical for certainly my firm. If it was only annual, I think there would be value in the information, but it wouldn't be particularly timely. And it could be so far past the point where it tells you what happened in the business in that quarter, that, again, it would be so much more useful to get it on an interim basis, in my opinion.
I guess I'll follow up and just say one thing that came up in our discussion is a lot of times we don't directly ask for this information because it's not publicly available. And so we don't think we'll be able to access it from the company. So just because we don't ask for it doesn't mean we don't want it. A lot of times we're concerned about, in some cases, having access to non-public information. So that's just one point. And then to the extent that maybe the feedback is the management teams don't look at or don't have access to this information, I'd find that pretty surprising and would want to know why. they don't look at it in this detail, since it does seem to be pretty relevant from a business perspective. And so just thought I'd add that.
That's helpful. Thank you. Thank you, Heather. Other comments from the group or board? Any questions about some of what we heard? Yeah, David.
Yeah, I might just add on to what Heather just said. Even in the case of manufacturing companies, I do see more granular information in some of the non-US companies I follow, and find that quite useful in making my projections there. So should be that information is important to their management decisions and something they track, and would seem that it should be available.
Great. Okay. If there's anything further, we can move on to the next topic we discussed, which was financial key performance indicators. We also had a very healthy discussion. I would say both topics, just about every single member weighed in. So it was really great to hear. I think first we'll move to Ron Graziano, who's going to lead us off here.
Thank you. Yeah, so just to summarize, I think the group, we all pretty much agree that this is a good idea, but at the same time recognizing some of the challenges that are out there. Some of the key points were, looking for a starting point, a metric that can be used across all industries. And I think most of the team agreed. Things like EBITDA, free cash flow, those are pretty much generally used metrics across most sectors. That could be a starting point. Again, pushback or challenge would be hard to define. If you ask 10 people how to define EBITDA or free cash flow, or 10 companies, you may get 10 different answers. So this could lead to even more adjusted versions for companies. But some feedback was the FASB could come up with a proposal, best practices. Here's a starting point. Company must start here. And then if there's deviations, they would be required to, kind of walk back and explain what those are. What are the number of adjustments that deviate from the FASB's best practice, or even from peers? Other KPIs that were also discussed that could be useful by industry, things such as same-store sales. And there's, a host of them that if you go down by sector. Organic sales was something that came up too, as well as FX. And there was some discussion about some of the challenges around companies and defining what organic sales would be. Some of the other industry specifics, there could be challenges there too. What are the most relevant KPIs per industry? This could be difficult, but this is something that could be pushed back on companies where, what is the chief decision officer person use to understand the performance of a company? We could also use things like AI and look at, hundreds or thousands of conference calls, press releases. What are the most commonly disclosed KPIs across the board, as well as by sector? And that could be a starting list too.
Great. Thank you, Ron. Next, move over to Dennis Neveling.
Yeah, thanks. I thought it was a great summary of what we discussed. I would probably just add that, yeah, specifically the difference between if we have a definition of EBITDA and then the adjusted number that company's given, looking at that definition, if there's a big difference, just enables investors to look at that and say, why is there a big difference, and ask the right questions and dig a little bit deeper. So I think it would be good to see the outliers between the definition of EBITDA and then what the companies adjust, like Ron said. And then one KPI that also Ron mentioned that I just want to add to here is organic sales growth. It's in the industry that I analyze, a very common one, and it's one that probably is helpful across other industries as well. So if we could agree on a definition, that is something where I think it would be helpful for investors to get a better understanding of the underlying growth rate. So adjusting for FX and acquisitions over time and having that very consistently applied, I think that will be helpful for investors.
Excellent. Thanks for that, Dennis. Any other members of the group want to add anything on? It was a great summary. Yeah, John helps.
Thank you. Thanks, Jeff. I'd like to just point out that the NAREIT, which is an industry organization, sort of has a test case of this already in action, where they've defined an FFO measure for the REITs. REITs are 10% of the small cap index. I know a lot of large cap people don't pay attention to it, but it's the largest subsector in the Russell. And I've spent a lot of time analyzing it. And the FFO is a very useful measure for me from a price to FFO valuation metric, as well as just normalization, standardization of results. And then the companies therefore then go after and say adjusted FFO. So they make their adjustments. And then, further beyond that is FAD, funds available for distribution, which would be FFO less straight line rents, which would be like a non-cash, think of it as cash EPS, and then minus maintenance CapEx. So yeah, there's going to be discrepancy in what CapEx is, maintenance versus growth, but it's still a useful number to have. And then just a baseline FFO, I really appreciate. Thanks.
Thanks for that, John. Others? Anyone else? Board members with questions on KPIs?
Hey Jeff, not a question, but really just a thank you. The financial KPIs, obviously it's a research project, so getting your input, what you do find helpful, what you don't find helpful is very important as we bring that to our board to make an agenda decision. So I just want to thank the group for weighing in.
Absolutely. It was a very, it was a great discussion. We certainly had a lot of chatter throughout the morning. Any other comments from other board members or questions about KPIs or going back to the DICE project? Okay, and Heather, I think your hand is up from before. I'm just double checking that just in case. Yeah. Excellent.
Yes. Sorry.
Okay. Yeah, no worries. All right. So lastly, before we sign off, I want to recognize a member who, unfortunately for us, will be rolling off the committee, and that's Mark Hamill. Mark's been a great contributor to the group since early 2019, and I personally really have gotten to know Mark quite well in that time frame. It's really been enjoyable spending time with him. He focuses on tech and software specifically, but he's gone out of his way really at every step of the process to find other colleagues who have expertise in the areas outside of his sector coverage. And really, his contributions to the organization have been highly valued. There have been many times when board members and staff have come up to me and mentioned how thoughtful and well received his perspectives have been. So, Mark, it's been a pleasure. I know we're going to stay in touch, and you're going to be a tough act to follow in the group. Although I think insider information suggests we might continue to have some sort of relationship with your firm, but I know we'll continue to speak. Your enthusiasm about your sector and on the accounting is going to make sure that we'll continue to have a relationship. So thank you so much. Hopefully you received something in the mail. If you haven't, it's coming. And we look forward to meeting with everyone next meeting, which will be most likely in May, but we'll finalize the details of that exact date soon. And we'll look forward to seeing you all then. So thank you very much.